Across the country, used car prices are imploding. Vehicles that once held their value for years are suddenly worth thousands less than they were just months ago. From family sedans to luxury SUVs, depreciation has gone from gradual to violent. And this isn't just market correction, it's something far deeper. A full-blown collapse is now underway in the automotive economy. Behind the headlines are three seismic forces ripping through the system. What you're about to hear could explain why your car just lost more value in 1 year than most do in 5. Watch to the end, because what's happening now will blindside anyone who doesn't see it coming. And when it hits, it'll be too late to prepare. Your car just crashed in value. Used car prices aren't slipping, they're falling off a cliff. Toyota Camrys with moderate mileage are selling for far below their expected market value. Factory-warranted Ford Explorers are going for nearly half of what private buyers were paying just 1 year earlier. From compact hatchbacks to full-size SUVs, the entire resale market is being flooded with discounted inventory. But what looks like a buyer's market is quietly turning into a trap. Drivers who financed their vehicles just 1 or 2 years ago are discovering they now owe far more than the car is worth. Trade-in values have evaporated. Loan-to-value ratios have flipped upside down. For many, what was once an asset is now a liability, and fast. The Tesla for $1,913. It sounded impossible, almost like a hoax. But in early 2024, a customer was offered a 2023 Tesla Model 3 for exactly $1,913. Not $19,000, not $9,000, $1,913. The original sale price, over $46,000. This was a nearly new electric car with barely 30,000 miles, sold by one of the largest rental companies in the world. Not some anonymous seller on Facebook. It was Hertz. And it wasn't just Teslas. Camrys, BMWs, Chevys, Explorers, vehicles across the spectrum were being liquidated for pennies on the dollar. Consumers celebrated the bargains, but for recent buyers, it was a financial ambush. Some couldn't refinance. Others were laughed out of dealerships when attempting to trade in. Forums lit up with stories of collapsed equity and irreversible losses. Cars weren't just transportation anymore. They were ticking time bombs on household budgets. The supply chain spinal snap. The chaos started years earlier. In the early days of the pandemic, automakers believed production would recover quickly. They expected delays, not disaster. But what they failed to understand was just how fragile the global supply chain had become. Microchips were the first to fall. These tiny components, essential to everything from ignition systems to safety features, suddenly became the bottleneck that brought the entire industry to its knees. Without chips, assembly lines in Michigan, Ontario, Bavaria, and Shizuoka shut down. Not temporarily, indefinitely. Vehicles sat half-finished in storage lots, waiting for a single part to bring them to life. But the breakdown didn't stop there. Ports around the world jammed with idle container ships. Steel deliveries missed deadlines. Rubber and aluminum supplies dried up. Wiring harnesses sourced from Eastern Europe vanished as regional factories shuttered. The once praised just-in-time manufacturing system collapsed under pressure, offering no cushion for disruption. Automakers scrambled. Ford began hoarding semiconductors. Toyota renegotiated long-standing supply agreements. General Motors stripped features from its cars just to keep units moving. But nothing could move fast enough. A single missing component meant an entire vehicle sat dead in the water. Meanwhile, demand didn't wait. Rental companies were desperate to replenish fleets. Dealerships had empty lots. Consumers faced record-high prices for limited inventory. But behind the scenes, the pressure was building. Then it snapped. As production finally resumed, a tidal wave of inventory hit the market all at once, at the exact moment when interest rates had spiked and consumer demand began to fade. The result? A market flooded with vehicles and no buyers. Prices plunged, trade-ins collapsed, equity vanished, and the people hit hardest weren't automakers. They were ordinary Americans who bought at the peak, only to watch their cars become financial dead weight. What began as a supply issue became a national economic gut punch. And it's not over. If this is hitting you like it's hitting the rest of the country, hit like to boost the signal and drop a comment if you've seen prices crash near you. Your story might be the next headline we investigate. Hertz is bleeding out? Hertz was once synonymous with global travel, with locations in nearly every major airport and city. It held the crown in the rental market for decades, but by 2024, that crown had turned to lead. Their billion-dollar bet on electric vehicles, meant to modernize their fleet, became a liability that shattered their balance sheet. They had bought tens of thousands of Teslas, Chevys, and other high-end electric vehicles, expecting demand and sustainability trends to work in their favor. Instead, they got a nightmare. Charging infrastructure was underdeveloped. Customers unfamiliar with electric vehicles returned them early or damaged them. Repairs were complex, expensive, and time-consuming. Some Teslas required specialized parts not stocked at most repair centers. A minor accident could put a car out of service for weeks, costing Hertz money by the hour. With repair costs soaring and utilization rates dropping, Hertz found itself stuck with vehicles it couldn't rent and couldn't afford to maintain. The company started liquidating fast. Vehicles with months of service left were offered at fire sale prices. Branch managers were given pricing flexibility and told to clear lots at any cost. The result? Cars sold for less than what the company still owed. Former employees described it as financial triage. And it wasn't just cars. Hertz began selling off real estate, software systems, and internal assets just to generate cash. Office furniture, information technology infrastructure. Everything had a price. For consumers, it looked like a jackpot. But to insiders, it was a sign of desperation. What looked like a single corporate failure was actually a warning shot echoing through the entire economy. Blindsided by recovery lies, analysts had warned about overproduction for years, but optimism was louder than caution. Auto executives were bullish, citing pent-up demand and low unemployment. Earnings calls in late 2022 sounded confident, even triumphant. CEOs assured investors that demand would hold strong, that price hikes were sustainable, and that the EV transition would fuel the next boom. They were wrong. The reality was far grimmer. Consumers were fatigued, interest rates rose, credit tightened. By the time dealers got their hands on new inventory, buyers had evaporated. Massive back orders from 2021 were filled, just as demand collapsed. Showrooms were full, but quiet. Loan approval rates dropped, and lease returns began stacking up. Everyone from Ford to Volkswagen saw inventories pile up faster than they could move them. Wall Street was slow to react. Stocks remained elevated even as fundamentals cracked. When the truth hit, when Hertz's collapse became public, when dealer discounts began flooding online listings, the illusion shattered. Analysts slashed projections. Banks retracted financing lines. Auto stocks plunged. The recovery wasn't real. It had been built on hope, debt, and lagging indicators. The first cracks had formed. Now the collapse was reaching everyone, from the boardroom to the border. Suppliers left to sink. When Hertz began dumping vehicles into the market, it wasn't just dealers and consumers who felt the ripple. Suppliers, especially Tier 1 and Tier 2 manufacturers, were the next to get swept away. These companies, often invisible to consumers, are the lifeblood of the auto industry. They make the brakes, sensors, batteries, semiconductors, plastics, seat fabrics, and even the software that make modern vehicles possible. And suddenly, their biggest customers, the automakers, started slashing orders. In the first quarter of 2024 alone, original equipment manufacturer contracts fell by over 18%. That might not sound like much, but in an industry that depends on volume to stay profitable, it was catastrophic. In Ohio, a Tier 1 chassis manufacturer furloughed 400 workers after Ford and Stellantis reduced their scheduled deliveries by nearly half. In Mexico, an interior systems plant that once ran 3 shifts per day consolidated to just 1. Warehouses filled with parts no one was ready to assemble. Production lines slowed to a crawl. And companies that had recently expanded based on rosy 2023 forecasts were suddenly left with excess capacity and no demand. For smaller Tier 2 suppliers, who often depend on a single OEM contract to survive, this was existential. Some shuttered completely, unable to pivot or restructure fast enough. Governments watched the bleeding and started drawing battle lines. Tariffs turned into weapons. As the auto industry began to falter, politicians didn't just respond, they retaliated. The first salvo came in the form of emergency tariffs. In Washington, D.C., congressional hearings painted a grim picture. Lawmakers argued that foreign auto imports, especially from China, were undercutting American manufacturers by leveraging unfair subsidies, low labor costs, and state-backed infrastructure advantages. The response? A proposed 35% tariff on Chinese electric vehicles entering the United States. But this wasn't just about protecting Detroit, it was about power. Vehicles had become symbols of national strength and economic security. The European Union quickly followed suit, launching a formal investigation into Chinese state support for automakers like BYD and NIO. In Germany, the backlash was especially tense. Automakers there depended on China both for parts and as a key customer base. Now, they were caught in a geopolitical crossfire. Subsidies became the next battleground. In North America, the Inflation Reduction Act funneled billions into domestic battery production and EV infrastructure. At the same time, it restricted federal tax credits to vehicles assembled in the United States or allied countries. This forced automakers to rethink their global manufacturing strategies almost overnight. Assembly lines planned for Mexico or Southeast Asia were abruptly redirected or canceled. As governments raced to weaponize the crisis, corporate leaders made their next move, and it wasn't pretty. CEOs in panic mode. By the spring of 2024, the mood inside auto company boardrooms had turned from anxious to desperate. What was supposed to be a golden era of electrification had become a minefield of miscalculations and misfires. EV adoption was slowing, not surging. Consumer interest had softened, infrastructure was lagging, and legacy automakers were sitting on billions in investment that no longer looked safe. At General Motors, a high-level strategic pivot scrapped plans for 2 upcoming internal combustion engine models, both of which were nearly ready for production. The reason? EV-first alignment with long-term investor targets. At the same time, they delayed several EV launches due to battery supply bottlenecks and tepid demand forecasts. It was whiplash. Ford, once hailed for its aggressive EV push with the F-150 Lightning, announced sudden layoffs at its electric vehicle division. Executives blamed temporary headwinds, but internal memos revealed deep concerns about rising unit costs and stagnant pre-orders. Meanwhile, Stellantis canceled its midsize sedan EV project altogether, redirecting funds toward hybrid updates, just 2 years after pledging an all-electric future. Legacy automakers scrambled to survive, while new players seized the chaos like predators sensing blood. China's silent invasion. While American and European auto giants twisted themselves into knots, a different kind of player was quietly seizing opportunity. Chinese EV manufacturers, once dismissed as regional niche builders, had matured, and they were no longer content to play defense. Companies like BYD, NIO, and XPeng began aggressively targeting Western markets, not just with price, but with polish. In Paris, sleek BYD showrooms began appearing in prime shopping districts, showcasing vehicles that matched Tesla in features but undercut them in cost by thousands. In Sao Paulo, NIO sponsored high-profile racing events to build brand recognition. In California, Chinese-made EVs entered dealership lots with shockingly low financing offers and cutting-edge designs. But it wasn't just design or marketing, it was logistics. Chinese automakers came armed with entire ecosystems, battery suppliers, software platforms, in-house logistics chains. They could undercut Western prices not just because of lower labor, but because of tighter vertical integration and state-backed expansion loans. The Chinese government had explicitly made EV dominance a strategic objective, and they were delivering. With the battlefield reset, the next wave of damage was heading straight for the consumer. Used cars? Unthinkable prices? It sounds like a dream. A nearly new Tesla Model 3 for less than $2,000. That's what one customer was offered by Hertz, 96% off the original price. It wasn't a typo. It wasn't a joke. It was the first unmistakable sign of a market in full collapse. And for some eager buyers, it looked like a once-in-a-lifetime opportunity. But beneath the shocking discounts lay a series of traps. These weren't ordinary used cars. Many of them, especially electric vehicles, came with hidden wear, battery degradation, and critical parts replaced with refurbished components. Hertz, in its scramble to stay afloat, was cutting corners just to move inventory. One customer in Texas bought a low-mileage Tesla Model Y for $12,000 under market value, only to learn 3 months later that a previous repair had voided the warranty on the battery controller. A $4,200 fix, out of pocket. The EVs in liquidation came with maintenance blind spots and warranty confusion. Dealerships were already aware of this risk. Private buyers were not. And the problem wasn't limited to high-end models. Even basic sedans and crossovers had been through dozens of renters, many with aggressive driving habits. Accelerated wear on transmissions, suspensions, and electronics made some of these cars money pits in disguise. If the prices didn't scare you, the hidden risks buried inside these cars should. Warranties can't save you. In normal times, used car dealers thrive on predictability. They buy low, sell a little higher, and manage the flow of inventory with seasonal demand. But nothing about 2024 was normal. With Hertz dumping tens of thousands of vehicles at liquidation prices, the math for independent dealers simply stopped working. In Ohio, a small dealership known for mid-tier imports saw its average margin drop from $3,500 per vehicle to just under $1,800. That's before reconditioning, staffing, and overhead. "We're losing money just opening the doors," the owner said. In Florida, another dealer slashed prices on all Toyota sedans after a Hertz fire sale dumped Camrys into the market at 15% below trade-in value. It was unsustainable. Inventory wasn't moving. Banks were tightening floor plan financing. Interest rates meant that holding onto cars for longer than 60 days could be ruinous. So some dealers began dumping their own inventory at a loss, just to stay liquid. Others tried to pivot to value-add strategies: light reconditioning, limited warranties, better customer service. But that required capital, and capital was evaporating. Behind every deal was a debt trap, one that millions were already falling into. Loans that break you? At first glance, it makes no sense. Hertz is offloading cars by the thousands. Rental company fleets are shrinking. So why are rental prices going up? The answer lies in a paradox of collapse. Inventory liquidation doesn't mean availability. It means instability. After the pandemic rewired travel behavior, the rental car industry never fully recovered its pre-2019 structure. Fleet utilization dropped. Corporate travel remained below expectations. And companies like Avis and Enterprise, seeing what happened to Hertz, began downsizing their fleets preemptively. The goal was to avoid getting caught in a similar debt spiral. As a result, when demand did spike during holiday weekends, major events, or business conventions, there weren't enough vehicles to go around. A compact car in Los Angeles during Memorial Day weekend? $300 per day. A minivan in Orlando for a family vacation? Over $1,200 for 5 days. These weren't premium vehicles, they were just scarce. Consumers noticed. Travel bloggers started tracking spikes. Booking app screenshots showing jaw-dropping prices went viral. Even rideshare drivers began complaining. They couldn't rent vehicles affordably enough to turn a profit. Meanwhile, renters who turned to peer-to-peer platforms like Turo found them flooded with former Hertz vehicles, some with unclear maintenance histories and insurance gray areas. Buyers thought electric would save them. Then the numbers started whispering something darker. Electric vehicles. No one wants. Where average buyers saw risk, a different class of buyer saw opportunity. Institutional investors, hedge funds, and private equity groups began circling the Hertz liquidation like sharks in shallow water. They weren't looking to rent. They weren't looking to drive. They were looking to flip. In New York, a syndicate of investors purchased over 300 vehicles at bulk discount from Hertz's private liquidation channel. Within 60 days, they'd resold 2/3 through online marketplaces and dealer auctions, netting a 12% return after fees and light reconditioning. One broker described it as free money if you move fast enough. Wall Street firms began partnering with independent mechanics, reconditioning shops, and even digital car retail startups to create mini fleets of flipped vehicles, sold just below traditional prices, but well above acquisition cost. Some created investor pools for used car arbitrage, turning buyers into micro-owners of distressed vehicles for passive income. Even more sophisticated operations started playing the geography game. A vehicle bought for $24,000 in Oklahoma could be relisted in San Francisco for $32,000. The arbitrage was all about speed, access, and volume. Private equity groups went a step further. They weren't just buying cars, they were buying the entire liquidation pipeline. Fleet software platforms, regional car haulers, repair contracts, all quietly acquired and bundled into asset plays. For the average consumer or small dealer, the system felt rigged. For the investors, it was gold rush economics. With consumers on the edge, the ripple effects were ready to go global. Trade wars hit home. A decade ago, cars were just commodities. Engines, wheels, and windows built where it was cheapest and shipped wherever they were needed. But in 2024, cars became symbols of national identity and geopolitical power. And suddenly, trade wars weren't just about tariffs. They were about jobs, ideology, and the future of manufacturing. As Chinese electric vehicle exports flooded the world, governments retaliated with unprecedented speed. The United States proposed a 35% tariff on Chinese EVs. The European Union launched anti-dumping investigations and considered new assembly requirements. India doubled import taxes on foreign EVs. Australia proposed bans on any vehicle with components sourced from specific Chinese suppliers. What had once been a global supply chain was now being redrawn by policy, one press release at a time. Behind the scenes, national security advisors whispered about cyber risks from foreign-made vehicle software. Economic policy teams scrambled to subsidize domestic battery production. Congressional aides drafted clauses requiring American soil final assembly for federal procurement. Globalization, once the religion of auto manufacturing, was being methodically dismantled by the very governments that once championed it. The result was a patchwork of conflicting regulations and economic zones. Vehicles priced for export suddenly became unprofitable. Assembly lines meant for shared platforms had to be reconfigured for country-specific compliance, and as margins evaporated, automakers passed the costs on to suppliers, workers, and eventually to you. While leaders fought their trade battles, workers were preparing for a different kind of war. Factories fall, fury rises. In Michigan, the last shift at an engine plant ended with silence. Not because no one cared, but because no one knew what to say. Nearly 400 workers were let go in one wave. Their jobs had been phased out, not because of automation, but because the plant was deemed strategically outdated under new electric vehicle mandates. It was the fifth major auto facility to shutter in the Midwest in 6 months. Labor unions weren't just upset, they were mobilizing. The United Auto Workers launched one of the largest multi-site strikes in modern history, targeting both traditional automakers and EV startups. Their message was simple: a transition to electric could not come at the cost of livelihoods. In Europe, the protests turned even louder. In France and Germany, picket lines formed outside newly built EV factories that had replaced legacy plants, many funded with state money, but staffed with fewer, lower-paid workers. The emotional toll was visible. Families that had relied on stable auto wages for generations were suddenly navigating gig work, unemployment paperwork, and early retirement. Strike signs read, "Green doesn't mean broke," and "No justice in just transition." The promised jobs of the EV future were arriving, but not fast enough, and not where they were needed. From picket lines to empty plants, the collapse was forcing alliances to break and reform. Alliances break, borders shift. As legacy automakers scrambled to stabilize, a silent revolution was unfolding in supply chains and corporate boardrooms. Global auto alliances, long the bedrock of platform sharing and technology licensing, were crumbling. In their place, strange new partnerships began to take shape. Ford and a South Korean battery manufacturer inked a 10-year deal to co-develop cobalt-free battery packs, sidestepping Chinese material sources entirely. Volkswagen abandoned its North American joint venture with a legacy supplier in favor of a new facility with a Taiwanese electronics giant. Stellantis committed over $3 billion to a new gigafactory in Canada, bypassing U.S. policy uncertainty entirely. The global auto industry was fracturing and fusing in new and unpredictable ways. Battery maps told the story best. Where once China had dominated raw material processing and cell production, the Western world was now racing to catch up. The United States had over 20 battery plants under construction. Europe pushed forward with a continent-wide battery alliance. South America negotiated new lithium deals with conditions that gave it unprecedented leverage. New factories opened, old ones closed, and through it all, daily life was quietly being rewritten. If you're still watching, you already know this isn't over. Subscribe now, because the next chapter will reveal who's surviving, who's lying, and what moves you must make next before it all changes again. You won't want to miss it. Your commute just got complicated. For many consumers, the auto crisis didn't start with a news alert. It started with a monthly payment that suddenly seemed too high, or an insurance renewal that had quietly jumped 15%, or a rideshare fare that used to be $10 but now costs $17. The car market was collapsing, but the pain was landing in everyday lives. EV affordability, once a promise, became a complicated math problem. Federal tax credits had strings attached. Dealership markups made base models rare, and used EVs, they were either suspiciously cheap or alarmingly risky. Online affordability calculators became common tools, but most ended in frustration. For some families, keeping their existing car on life support became the only viable option. Commutes changed. With fewer affordable vehicles available, more people stayed local or turned to public transit, scooters, and carpooling. Rural areas suffered the most. In regions without robust transit, the lack of reliable, affordable vehicles meant missed work, missed school, and growing isolation. Meanwhile, insurance companies reevaluated everything. Vehicles purchased through liquidation channels were flagged as higher risk. Some policies excluded coverage for refurbished battery systems entirely. Premiums rose across the board, and in states where EV adoption surged, rate hikes were even sharper. This isn't just a story about cars. It's a story about survival. The collapse is unfolding in real time, and the people who understand it early will walk away with the advantage. So if you've made it this far, don't stop now. Subscribe for the next wave of insights before the headlines catch up. Drop a comment with what you're seeing where you live. Your story matters here. Because in the middle of this chaos, information isn't just power, it's protection. And the next chapter is coming fast.